Okay, we're continuing right on here in part 2 of the video we just completed. We left off on this day, the trading of June 17th, and now we're looking at the 18th. So after the market closed then, you have your levels for the next day, which would be June 18th. And we're just going to go through quickly now just to show you how consistently the price action will behave in a way that can give you tradable opportunities day in and day out. So here's the value area low, the point of control, and the value area high for this day. So they went down strong off the open, tested the value area low, found plenty of demand. The buyers were there. There wasn't any opportunity to sell anymore, so it came back very quickly. By 9 o'clock, you're back at the point of control. Tested it for a long time, an hour and a half, and if you see this kind of behavior, it's just sitting on the point of control. It's an extremely high probability opportunity that you can make it all the way to the value area high, which they did. But in this case, they were rejected there. You can see for scalpers what a huge number of opportunities are going to come during the day to trade. You might have traded this one up and down 8, 9, 10 times in that amount and gotten your quota for the day. Quick scalp here, etc. But for those who want to maximize their wins, you know, you have from 505 here to 509, 440, 50 at the high tick. So you're looking at a good $400, $450 a contract potential on that trade, and then you have behavior coming down again. It's all, you had a retest here, could have been faded. Many opportunities are going to present themselves. Now the following day, you had a gap up from a very narrow value area, and the question is, are they ready to break out? Well, we got the reversion to the mean factor to consider again, and we also have our earlier value areas that we should take into account. So this is where that value area low was. Remember the one that market wasn't strong enough to even make it back there? Well, that's still a formidable resistance in that case. So when they gapped up the next morning, guess what? You had a double top here. Very tradable, observable. You always look back a few days. You look at all the important value area levels, and you can come up with very strong probabilities that the market is going to respect these levels. Now we mentioned it a little. Let's bring it in a little bit here, that you also can combine with the pivot numbers. And here was resistance 2, resistance 1. They came down to the prior day's high, which is a strong level, and then right down to the value area high. So they made it back, and there was a lot of other support there. So there was a very tradable bounce, only for scalping as it turned out. But then when they probed a little lower later, that's all it was. This was a fake out, a stop run, or whatever you want to call it. So this again is strongly indicated by the value area high holding, because they probed through and it was rejected very quickly. So this becomes a very high probability trade that can give you a good profit. And as you can see, it went from the 508 level. The high tick was $400 above that. So more tradable opportunities day in and day out, simply off the levels. Once again, the gap under the value area on a breakaway gap that once it's held for 15-20 minutes, and then on this bar, when you are clearly even regaining this level, this would be the next target. 2 days earlier value area low, and they went through very quickly. So knowing these levels and knowing that the market is not finding any demand from buyers at those levels is very strong indication of a trend. And so you want to favor trades. Find a way to get in on these. And again, we'll talk about that later when we get to the smaller time frames. How would you have participated in this? Because most traders are very, very reluctant to just jump in on a huge breakout like this, and with good reason. It's not very high probability. So you want to refine your entry techniques to enable you to participate in the big moves, even when there isn't much of an opportunity to get a really ideal entry. In this case, you would have had to just sell in the open. That would have been tough. But you can look at a breakout of a 3-minute or 5-minute bar. You can look at the very first retracement of a short time frame bar, and then using a tight stop, because you got back more than half of the way here. A stop up here would have given you a very, very low risk if you got in on the first little pullback, 460 to 650. You're talking $200 a contract. It's reasonable. Now, moving on, we have another value area that was rejected. The point of control sent the market lower. This is indicating the trend is intact. New sellers are still initiating. And finally, we have a lot of what we describe in market profile as rotation at a level. So at this point, the market's indicating it's probably going to make an attempt of getting back to some value. This value is being established that no one wants to initiate selling anymore. The price is just rotating. So these kinds of rotations are what you look for to signal the end of a period of a few days of initiating lower or initiating higher, where the range was extended and new lows were made or new highs were made. In this case, the new lows then created so much activity that this was your value area for the next day, and that can be considered very, very strong support under the market, because that was where they established value the day before. So when you gap up here, and again in the beginning you have no interest, there is no more selling interest, you would want to find a way here because to get in, to participate, because they have regained the prior day's value area, and they did it very, very quickly off the open. So you're getting strong confirmation they're not getting rejected by that low. So now you're looking for that 80% rule, that you can make a trade at least all the way to the value area high, which is good profit. So that's exactly what the market did, and when it got there, it gave its best shot. But now you have another way we could use these levels, is we're looking at the retest failure. Once it gets back in under that level, that's telling us they're either looking for value down there, or they're maybe going back to the value of the current day, because they weren't ready to get past this. This is support on the way down becomes formidable resistance until you have enough testing. And this is what you got down here. They did hold on the value area, so at least they closed the day above the value area for the day, which is very bullish. So when they gapped down the next day in that value area and immediately rejected it, we're looking for higher levels again. So we go through this process day after day after day, and we're going to stop here. Well, let's go a little longer, just to begin to look more quickly at day to day. We go through it. Now we're extending, and if we look back, we'll see that we're probably we're regaining this value area here. So now the market's saying maybe it can get back to these levels it was rejected from before, and you see it holding in the upper half of value area in this day. So this is telling us it's a consolidation. The attempt to break the value area quickly rejected here. Now you've got 2 days of holding. They try to go a little higher, but this time they want to they think maybe it's a double top. They go down lower, and it regains the value area on the close. So they finally get higher the next day. So this goes on and on. Now we're going to do a part 3, so don't go away. Come back for part 3 of this video.